Welcome, everyone. I'm Angelo Robles to the Angelo Robles Podcast. I'm also the founder and CEO at Family Office Association. Today's session is everything you wanted to know about SPACs. It features the right person to have on. I'm very excited. David Boris of Forum Merger. David, welcome to the show.
Thanks for having me. It's a pleasure to be here.
I'm going to start off with the most simplistic of questions, but that usually is a good way to start. What is a SPAC?
So a SPAC is a special purpose acquisition company, or at least that's what it stands for. And it really just breaks down like this. A management team, and in SPAC parlance, that's generally referred to as a sponsor, does an initial public offering, which looks a lot like any other initial public offering in some respects. Generally traded on the NASDAQ, although some are on the New York Stock Exchange, of what is a blind pool. So you're doing an IPO. Sounds like a Seinfeld episode. It's an IPO about nothing, but you're raising a pool of money with no idea of what target company you're going to invest in when you start. Let's say that's a $250 million is raised in that IPO. All of the money from that IPO gets put into a trust account for the benefit of the shareholders. And generally when a SPAC goes public, it goes public in a unit, and there are some minor tweaks, and I'm sure we'll get into it, Angela, but SPACs go public in a unit. So instead of a normal IPO where you're buying one share of common stock, in a SPAC, you're generally buying one share of common stock and all or part of a warrant, which is a warrant to buy an additional share of common stock. So all of the proceeds from that IPO get put into the bank, into a trust account, invested in treasury securities. And then the SPAC sponsor has up to generally 2 years to run around and try to find a private company that wants to go public and would benefit by being public by merging with the SPAC. So the SPAC has a public listing and cash, and obviously the ability to issue more securities. The private company wants the public listing. They want the cash, either for their shareholders or to operate their business. The two companies merge. The new company is a publicly traded company on whatever stock exchange, and the private company has then gone public over, by virtue of this reverse merger.
Great. That explains what is a SPAC and to some degree how it works. So there's three core participants, I guess you could say: the sponsor, the target company, and the investor. If you could explain a little bit from each of their perspective.
Sure. It's funny you ask it that way, because that's exactly how I look at it. And when I try and explain SPACs to my friends, this is where I go. So I look at it as a three-legged stool. This is what makes the SPAC market go around. So we'll start with, start anywhere. We'll start with the sponsor. So a management team gets together and says, we want to sponsor a SPAC. Why did they do it? Well, they do it to make money. It's a financial transaction.
Yes.
People are doing this for a straightforward reason. So what's in it for the SPAC sponsor? The SPAC sponsor puts up all of the risk capital, which is millions of dollars to get a SPAC transaction done. So it's not cheap, and it's not so easy. But for that, the SPAC sponsor ends up owning a material piece, what ends up being 20% of the public company, for a substantially discounted price. So the SPAC sponsor gets no salary. They get some expenses covered during the transaction. They're really obligating themselves to spend a substantial or all of their time on this process that could take 2 years. They could lose all of their money if it doesn't go well. But they do have substantial upside because they own a lot of stock at a relatively attractive valuation, a very attractive valuation. That's what's in it for the sponsor. What's in it for the public investor is this optionality. So when a SPAC goes public, it prices at $10. Almost every SPAC, Bill Ackman aside, prices at $10. And that $10 is the unit. That's either a share and a full warrant, a half a warrant, a quarter warrant, a third of a warrant, but it's a share and some warrant component. And that trades on the exchange. When the SPAC announces its business combination, shareholders have the right to say at that point, first of all, they can trade anytime they want. It's public stock. They can buy it on Monday and sell it on Tuesday. So that's different than, private equity. But once the business combination is announced, shareholders can say, wow, I love that deal. And the stock trades up. Shareholders can say, that's really not what I bargained for. I would rather have my $10 back. And so they have the right to redeem those shares. So unlike a normal private equity fund where, you're putting your money into a deal, you're waiting some number of years and you don't really get a say as to what they're investing in a SPAC, you're putting your money in. If you buy the IPO, which is the easy analysis, right? You put your money in at $10, you can always get back your $10. So you have a riskless trade in that respect. You have value in your warrant. And hopefully the management team announces a deal that's exciting and the market's excited about, the stock trades up. So for what you thought might be a riskless trade, you ended up making a above average rate of return. So that's what's in it for the public investor.
Before we get to the company, the third leg of the stool, the company being acquired,
sure.
Let me ask a question about that. So if I'm an investor, I potentially see the opportunity here, but I don't know what the sponsor is investing in. Is that going to make me skew towards people that have a tremendous track record? Do I have some clarity of the direction that they're going? Because I am writing effectively a blank check here.
You're writing a blank check, but with the right to get it back, which is unique
True.
to the structure. So when the management teams, the sponsor, if you will, does a SPAC, they're not all alike. So some, like the SPAC that I am co-chairman of, co-CEO of, along with my partner, Marshall Keefe, we're generalists. I grew up as a generalist investment banker. He grew up in the family office world, being very generalist in his investing. So we'll look at anything. And, maybe later we'll talk about the 2 deals we've already closed in our first 2 SPACs and the third one that's pending, because they are kind of all over the board in terms of industry. There are some SPAC teams that have a different attitude. Maybe it's a team of healthcare experts. Maybe they're a healthcare fund. Maybe they're an Israeli technology fund. Maybe they're a Greek shipping family. And so they'll say, we're doing a SPAC that is intended to be in this area of expertise. But we also reserve the right to go do a different deal if we see it. And so, there have been cannabis SPACs that have done EV deals because they found a better EV deal than they found, I assume, a cannabis deal. So SPAC teams are generally not limited in what they do, but there are some teams that definitely go out with either a industry focus or a geographic focus. And then there are some teams that go out as generalists. So if you really have a specific industry you're in love with, you could probably find a SPAC team that's looking in that area.
Great. And the third leg of the stool, of course, is the company being acquired. What's in it for them?
That's exactly right. So I'm a private company, and those fall into a few buckets, right? So they could be portfolio companies of private equity firms that are considering either a sale or an IPO. They could be family businesses that have decided not to go the private equity route, maybe for control issues or what have you. And so this is an opportunity. So what's in it for a private company? So number one is, why would a private company ever just go public, right? Why would you want to be a public company? And I think we all know those reasons. There's liquidity. There's better visibility for your brand. There's the ability to recruit and retain employees with stock options. There's access to capital in the public markets. All the reasons companies go public. We know the reasons people don't go public. It's a pain in the neck. There's a lot of regulatory hurdles. There's costs involved, of course. But if a company has decided to cross that bridge and go public, then why would they merge with a SPAC instead of a traditional IPO? We can get into as much or as little detail as you want. But basically, if you're a private company and you're thinking of going public, the SPAC can get you there faster than a traditional IPO, generally with more certainty in terms of valuation, because in a merger, you have counterparties sitting across a table. Company says, I want to merge with you. This is what I think my value is. We say, no, this is what we think your value is. And you have a debate and you reach an agreement. In an IPO, you don't really know what value you're coming public at until, a day before the IPO, maybe even 5 minutes before the IPO, if you're lucky. And deals can get upsized, deals can get downsized. So there's a lot of benefits why a company might merge with a SPAC. In addition, and I'm sure we'll get into this, in a traditional IPO, it's very hard or frowned upon, let's say, for the management team or the owners of the company to sell into the IPO, to be selling shareholders,
Right.
because the underwriters will say, if you're selling, why would investors want to buy, right? But in a SPAC, since it's a merger, it's very common for the current shareholders to say, I want to take some of my capital off the table, especially if they're a private equity fund. That's the business they're in, is taking money off the table and reinvesting. So here you can actually get your IPO done and at the same time get some partial liquidity. So SPACs have a built-in sort of structural advantage over traditional IPO in that respect.
And in terms of, I remember hearing about SPACs years ago, and they appear to kind of wane a little bit, but they are back at a vengeance over the last 2 or so years. Give us a little bit of the history of SPACs.
Well, that's a dangerous question because I am old enough to have been there. So I worked on my first SPAC in the early 1990s, totally by mistake. I was an M&A banker. Friends of mine had done one of the first 2 or 3 SPACs. They needed an M&A advisor, and I said, "What an M&A advisor to a what?" And so that piqued my interest, and I've been around the product then for the last 30 years. It's what SPACs have ebbed and flowed. You're exactly right. So when they first started out, they were very small. $20 million SPAC was a big SPAC, or $30 million SPAC. And now there have been $4 billion SPACs. So the product, SPAC product, with the IPOs were smaller. The structure was different. It had more warrants. They were in the money. It was much more dilutive. Things were different back then. And so they were, more entrepreneurial type backers doing smaller deals. Some worked, some didn't. And I think, to some degree that tainted the industry. What then happened was the internet boom came along, if you remember those days. And people said, well, why would I invest in a SPAC whose primary structure is safety, right? I can get my money back. I'm not looking for a low return vehicle. I want to go buy the next Google or Yahoo or what have you. So for a decade, no SPACs were done. It's just an amazing, from a Wall Street history perspective, you had this product that had some good legs, then it just stopped. Then after the sort of tech bust, some of the folks that were involved in SPACs in the beginning said, wait a minute, people now lost money in these high flying IPOs. Maybe the SPAC can come back. And over time, what happened was large hedge funds, large institutional investors, quality management teams all said, wait a minute, this product could really work, if we all use it correctly. And so now you've had amazing numbers. And let me just tell you, these are the only time I'll cheat and give you some statistics here. So there have been 676 SPACs done, raising $163 billion since inception. These numbers are coming off SPAC Analytics, and they're a very reputable source for the industry. Last year, 2020, there were 248 SPACs done, representing 55% of all IPOs done in the US were SPACs.
Wow.
Raising a total of $83 billion. So far this year, and we're only on, January 13th, there have been 40 SPACs representing 95% of all IPO volume in America, and have raised $10 billion so far this year. So the numbers are big, they can't be ignored, and SPACs do mergers that are bigger than the SPAC. We'll talk about that, but generally, if a SPAC is a $200 million SPAC, it's looking to do a $400 or $500 million or bigger deal. So so right now there are $180 billion of SPACs looking for deals. So that will generate, and this is a Goldman Sachs was talking about this yesterday on their podcast. That was going to generate probably $500 billion of M&A business in the next 2 years. So it is definitely getting attention.
It sure is. And I mean, I'm thinking of some of the bigger names out there, Richard Branson's Virgin Galactic, the venture capitalist Chamath Palihapitiya, DraftKings, I guess, was last year. And I'm assuming the biggest one is at Bill Ackman's Pershing Square Tontine Holdings.
Yeah, so Tontine was a record setter. It was, for those of us that are in the industry, when the first $1 billion SPACs got done, people said, wow, that's $1 billion. You have to go merge with a $5 billion company or a $3 billion company to make that work. How many $3 or $4 or $5 billion private companies are around to talk to? And then you had, Bill Ackman go out and do a $4 billion SPAC, and, just amazing. So the quality of people who are issuing SPACs continues to improve. The quality of companies they merge with then improves. And then that rising tide just lifts all ships. So then SPACs are taken more seriously by, if you're an investment bank talking to a private company about being sold or going public, if you now basically have to have a page in your deck that says, or merge with a SPAC. Right?
Yes, that is, who would have thought that maybe even a year and a half, 2 years ago?
Right.
I mean, if I guess from the investor perspective, and probably a little more the traditional retail, the advantages are effectively they're cheap for usually, again, that $10 a share. They could invest in hot areas. They're open to, as I said, individual investors. The disadvantages, blind pool, lag time, and I mean, honestly, somewhat of a mixed track record.
Yeah, no, look, the appeal to the individual investor is certainly that lower downside. Again, if you're buying it, at or around the IPO value, and upside. I mean, DraftKings is at $55 today. I mean, you could have bought it. You could have bought DraftKings, the SPAC with a warrant for $10. So I mean, it's a amazing rate of return for the SPACs that work extremely well.
And I'm going to get to the tough questions relatively shortly. We'll do the deep dive into.
You said
warrants.
no tough questions, Angela.
Well, thank you. But I do think, someone that we've had speak at FOA before, and someone who I've interviewed on my show, more so on climate change and other issues, is a very prominent investor, Jeremy Grantham. And he's been very, very vocal. Bluntly, he says he thinks they should be illegal. They escape regulatory oversight and encourage the most obscene type of investing, quoting from him. I'm not going to ask you why he feels that way. I would ask him that. Where is he right or wrong? I mean, they escape regulatory oversight.
No. Okay. Yeah. So obviously he's a, very intelligent guy and a great speaker. I've had the pleasure of seeing him speak. I don't know exactly what his hot button is with SPACs, but let's just take that apart for a minute. So on the regulatory oversight, you're a SPAC and you're going public. You do not have a target company in mind. That is a real violation. And why? Well, because people come to me all the time and say, well, I have this company. I think it would be great to go public. Why don't you go out and do a SPAC and buy it, right? And you say, no, you're not allowed to do that. So a prospectus in an IPO is supposed to give investors all the necessary information that they would want to make an investment decision, right? So if you had a target, you would have to disclose that target in your prospectus, and then it wouldn't be a SPAC because you'd be an IPO. So when you go public, you don't know your target, and you represent that you don't know your target, and that's how this works. And you file a registration statement that goes through the SEC. We go out of our way to have quality underwriters and quality lawyers and quality investors buying our deal, and we think. Speaking for Marshall and me, we think the system works, or I think the system works. So there is, getting public, you're under the exact same, your prospectus is reviewed by the same examiner at the SEC who would be reviewing a normal IPO. When you do your business combination, you file a merger proxy that's reviewed by the SEC in great detail, I can tell you, because been through it both as a principal and a banker. And so they look at it at the SEC as very much reviewing an IPO or any other merger. So I don't see, that the we function on the exchange. We're governed by the same rules for the most part as other companies on the exchange. If that's not the case, it's actually the rules are tougher on SPACs than they are on traditional companies. So I would disagree with that. I think we're under the same regulatory guns. And look, could there be bad apples in the SPAC bunch? Sure, just like there are in other industries. But I'd say that's the exception, certainly not the rule.
I mean, I guess you partially answered it before, but I think it still is important to drill down. How are SPAC sponsors compensated and incentivized, and do you see this changing?
Well, so SPAC sponsors are compensated 100% by stock. So you're getting cheap stock by forming the SPAC, putting up the risk capital, getting it public, and spending 2 years of your life looking for a great merger, convincing that target company that you're the right SPAC to merge with, explaining to the public why this is the right deal, and all the things that go into that. So it's a lot of work. So look, you in a private equity fund, the sponsor, the fund gets a promote that's basically usually 2 and 20 or something, right? So they're getting a percentage of the profits of their investments. In a SPAC, you're taking risk capital, but you're participating from $1 because you are a shareholder on an attractive basis. So when people want to take a knock on SPACs, sometimes they say, well, and the management team, the SPAC sponsor, makes too much money versus other investment opportunities. And I definitely talk in my book here because I'm a SPAC sponsor, but there's an equilibrium, I'd say. At some point, investors have bought 676 of these things and have put $163 billion in. So they obviously feel that SPAC sponsors are being compensated fairly, or else they wouldn't invest, or if they felt there was an unfair advantage to the sponsor. So that's, I definitely have heard that complaint. I've heard theories that over time these will change. And then there have been, and again, I'm not an expert on Bill Ackman's deal because I have my own deals to worry about, fortunately. But I know that he has a slightly different management promote structure than other people have. And there have been, of the 670 SPACs that have been done, there have been a few, very few, that have tried to change the structure. And, generally the underwriters and the investors say, look, it's not broken. We want to know that your compensation, your management shares are just like everybody else's. I don't want to spend 20 minutes of my roadshow in front of an investor explaining to them why I'm different in my management, economics. So, if it's worked over 600 times, why not keep it? And so is there a chance that over time the management promotes will change, the economics will change? I guess, but it hasn't, in the 250 that were done last year and the 40 that were done this year.
Will there be a new trend in the future of SPACs that do not have warrants attached? I believe it's starting already. And why don't we take a step back, explain what warrants are, then answer that question?
Fair enough. So warrants, not as popular, right? In SPAC land, very popular. Outside of SPACs, you can't name a company that has a warrant, but a warrant is just a long-term option. And everybody knows what an option is. So the vast majority of SPACs, again, very few exceptions, a handful, so let's not focus on those. The majority of SPACs come public at $10 for the common share and in a unit. And the unit consists of all or part of a warrant. So you either get a full warrant, a half a warrant, a third of a warrant. That just sort of depends on market conditions and at the time of the IPO and who the SPAC sponsor is. That warrant is the 5-year right to buy an additional share of common stock at $11.50 a share. So starting with the day of the business combination. So if a SPAC goes public, takes a year to find a company and merge with it. When that merger happens, the day that merger closes, that warrant is the right to buy an additional share for the next 5 years. And so that warrant has value, and that value is what makes, an investor interested in investing in SPACs, right? If I said to you, give me $10, I'm going to go try to find a company to buy, and if I don't, I'll just give you your $10 back. That's okay. That's one proposition, but I say, give me $10. I'm going to go try to find a company to merge with. And I'm also going to give you, in addition to a share with $10 in cash, I'm going to give you this warrant that also has upside. So even if you don't like my deal, you can still take your $10 back and you can sell your warrant and have an extra profit there. So the vast majority of SPACs have a warrant. Some transactions, there was a deal, I forget the name, but the SPAC that merged with Playboy recently didn't have a warrant, but they had a right.
That would be Mountain Crest.
That would be correct. SPACs for 50. So a couple of things, on that. So on a right, the right is the right to. The right converts into generally 1/10 of a share of common. So if your stock's a $10 stock, the right is basically perceived as being worth $1. So instead of having a warrant, which is exercisable at $11.50 or a 15% premium, the right is convertible automatically at par at $10.
Right.
So arguably, from a corporate finance perspective, the right is more dilutive than the warrant, so less attractive. And in that, again, I don't want to talk about other people's deals because I don't know them all ins and outs, but that was a relatively small SPAC. It was a $50 million SPAC that did that. And I believe, the average SPAC size is now over 250 million. And, as we know, there have been SPACs above $1 billion. So you see these, non-traditional structures like give up the warrant but put in a right tend to be in smaller SPACs.
Will the PIPE continue to be $10 per share, or will that also evolve?
I think everybody kind of wants to hold the line on $10. So let's talk about what a PIPE is for a moment, I guess, and how SPACs use them, because not everybody on this call may know. So we've established that when you go public in a SPAC, you raise your 100 million, 200 million, 4 billion, whatever it is, and you put that into a trust account for the benefit of the shareholders. Then you go out and you find your business combination. Well, the company you're merging with says, well, look, you're a SPAC. Your shareholders have the right to redeem. How do I know that the 200 million or $1 billion you have in the bank, how do I know that that's really going to be there when we close? And so you say, okay, why don't we go out? We're going to do our merger, but before we announce it, let's go out, meet with some institutional investors, some strategic investors, some family offices, and get them in, bring them over the wall, tell them about the transaction in a PIPE, and a PIPE is a private investment in public equities. Mm-hmm. And have this group invest in the deal. So when very often, and the number is actually over 80% of the time now, when you see a SPAC announce a deal, they'll say, this SPAC is merging with this company in a transaction valued at X. And then the next paragraph says, institutional investors and family offices, have already committed $200 million, $100 million, whatever the number is, in a simultaneous PIPE at 10. So it's good for the SPAC, because it allows them to go out and talk to real investors who are committing real checks. It's a very good market check. Hey, people do like what we're doing. They're willing to invest, right? It's good for those investors because so let's say you're doing a $200 million PIPE. If you're an investor and you want to write a $25 million check into a deal, into a PIPE deal, a SPAC deal, it's very hard to do that in the public market without interfering with the public price. But in the PIPE, you're subscribing in advance, you're getting filled at $10. So if the deal gets announced and the stock trades up, you have a built-in gain at that point. So it's good for the investor. because they get an early look at the deal before it's announced and they get to invest. It's good for the SPAC and for the target company because it brings sort of third-party credibility. So generally you want to do the PIPE at $10 because that's where the public investors are. So if you start dropping the price on your PIPE, then the public says, well, you sold it to this guy at $9. Why should I buy it at $10? And you just cause some disharmony. So it's much better if you can do it to keep your PIPE at $10. And I think you're just going to see that stick if possible.
What are the key negotiating issues between a SPAC and its target company?
Well, it's a great question. As you might expect, there's many. I mean, so first there's valuation. Don't forget, the target companies going public. This is to them probably the biggest thing they'll ever do, right? The decision to be a public company. And they're doing it through a SPAC because they think they're getting a better valuation or a faster process or a more secure process. So one clearly is valuation. If you're totally off the mark, you don't see eye to eye on value, you don't really have a lot else to talk about. Then there's the partnership. Generally the SPAC is going to be a large shareholder. The founders of the SPAC are going to be large shareholders in the public company, or relatively large. They're generally going to have board representation. So the question is, do these folks bring something to the table that you think is valuable? Do you like these people? Would you want them as your partners and directors? And what else? Then you brought up the issue earlier, Angela, about track record and such. Why do these people know what they're doing in SPACs? Why should I entrust this huge IPO, this big opportunity for my company with these people? What's their credibility? What's their track record? So it basically starts with valuation, then becomes, are these people the right business partner for me? What do they bring? If I'm looking for them to bring anything, right? And we mentioned this earlier, you can have a SPAC that merges with a private company, and takes 90% control of the business. It's essentially what a private equity fund would do. And you're basically cashing out the existing investors. So they may not care too much about, board control and stuff because they're gone. You may have a transaction in which 100% of the current shareholders of the private company are rolling in all of the transactions that we've done in our forum SPAC, Forum 1, 2, and 3. We've had a very, very substantial role from the management team in which they've kept control. And that's really important to us. We view ourselves as a partner, providing a financial vehicle for them to get public and grow their business. We're not looking to control the company and run it. So what you're looking for out of your SPAC sponsor partner differs, and what the SPAC might be looking for differs. Some SPACs are looking for control. Some SPACs are looking to be more minority investors.
What are the key legal issues that arise in SPACs?
Oh boy. So very similar to, so you take an IPO, you have all the normal legal issues of an IPO. Is the company ready? Do they have the books and records and the sort of depth of management team to go? Can they physically handle, being a public company, all that entails from not only a legal perspective, but every perspective. Then it's a merger on top of that, right? And so when we're as a SPAC, we do complete legal diligence on our target companies, make sure that what we think we're getting from a legal perspective is what we're getting, and if not, we work with the company to make the necessary changes to deliver to our investors, our shareholders, what we bargained for. So, believe it or not, this is one of my pet peeves. SPACs have to file for antitrust clearance. So even though you don't have a business and you can't possibly be an antitrust risk, this is a toll that the government takes from every company going through a merger. You have to file for antitrust clearance, and it's a meaningful amount of money. So from a legal question, yes, you have to file Hart-Scott. But you're putting together as we said earlier, a very complicated merger agreement and a very complicated proxy statement, and all the risk factors, all the disclosure that goes into that are are key. So we advice I give people who are thinking of doing a SPAC and get asked all the time now, make sure you have a great underwriter, make sure you have a top-notch law firm, because it's it is a specialty product, and it's not the same just because your lawyer or your banker knows how to do a regular way IPO doesn't mean that he or she knows how to do a SPAC, and it's a little bit different.
What would be a singular key risk associated with SPACs for each of the three participants, the sponsor, the target company, and the investor?
Yeah, sure. So from the sponsor perspective, not that I think about this all day and night, it's, you're risking, you can lose all your money. And you've put up the risk capital. If you don't get a transaction across the finish line that investors, the public likes and votes on in a shareholder meeting, you risk losing all your money and 2 years of your time and your investors' money if you have partners in your SPAC. So that's no good. So that's the risk that and of course reputational risk. Nobody wants to do a SPAC that fails and such, right? From the the public investor, so you got to draw that line from the IPO of the SPAC to the day of the merger. You have a publicly traded stock. You can do whatever you want. You can buy, you can sell, and you can also redeem at the $10 plus some accrued interest because the money's been sitting in treasury accounts. Once the merger is done, and it's done, then the company trades just like any other public company, and the stock can go up and the stock can go down. And so you have normal public market risk, normal risk. Should note at this point that to the best of my knowledge, the SPAC structure has never failed, right? So if you buy a stock and you say, I want to redeem my $10, you always get your $10 back. I don't know of any case where a SPAC has ever said, oh, we're sorry, we only have $8. That's not permitted. And I think it's never.
I do think we might have froze, as I noted when we began, not on my end, but on David's. David, I don't know if you could hear me, but you're frozen on screen. You might, a keyword I used is might, be able to use the dial-in, and I could find you and make the voice work. We could give it a try. We did get pretty deep into the conversation. I had a couple of more questions left. David might be back. I see your picture, David, but I have to find you and open you up. Give me a second.
I am back.
Okay, you're back.
Thank you. I apologize. I told you that always happens at the
I did warn the audience. David is such a great guest, but it's just that might have happened. So hopefully that'll be the only little interruption. It gave people a chance to take a break and get a drink of water.
Apologies to the audience. Thanks. I don't know where did I cut off, Angelo? You were asking about the risk.
What is the key risk, sponsor, investor? I don't think you mentioned a key risk for the target company yet.
Okay, great. So the target company, so the risk for the target company in merging with a SPAC, the downside to a SPAC for a target company is that you do have the management shares, right? So the reason the management does the transaction is to get those shares because they have value, but they are obviously provide some dilution to the structure. So that's the negative of a SPAC from the perspective of the target company. This management team is getting a bunch of cheap stock in my company. Why do they deserve that, right? But otherwise, it is, look, it's a tough process to go through any merger. Big SEC reviews, big merger proxies, lots of drain on your management team going through it, but no different than if you were going to do a regular merger or a regular
For
IPO.
sure. Yeah. And some of our families see SPACs as a bond proxy. Any thoughts?
Yeah. So I am talk a little bit about so there are a couple of different investment strategies in SPACs, and this just goes back to the public investor thing, right? So as we said, you buy the IPO, you're getting a share in a warrant or share. Let's just make it easy. You're getting a share in a warrant for $10. The IPO comes out and that money is invested in treasuries. So the SPAC is earning in treasuries, basically what you as a family office might earn by investing your money in treasuries, right? Same treasury. But you also have this warrant. So let's just say you buy the IPO at 10 and you sell the warrant. Let's just make up a number. You sell the warrant at 50 cents. So now you have you're net into the deal for $9.50. But you can always get $10 by redeeming if you choose to down the road. So now you have this built-in profit. You have a riskless return. If you do the math, it works out to higher than treasury bond return. So the SPAC is invested in treasuries. So you're taking treasury bond risk, but yet you have a higher return than treasuries. And if the company does a great deal, a DraftKings, and the stock goes to 30, right? You now are in for 9 and the stock's at 30 and you had a riskless trade on. So we do see a number of people saying, look, instead of having my money in the bank in these low interest rate environments, why don't I buy a bunch of SPACs? I can either buy the unit and keep it. I can buy the unit and sell the warrant. And as you might imagine, there are funds out there who just love SPAC warrants. So they are happy to buy the warrant and not keep the stock, right? So that's what makes the market go around. So sure. It is that the idea of using SPACs as a bond substitute makes a lot of sense.
Well, I mean, on that note, because some people may be wondering, if I elect to invest in a SPAC, what am I investing in from an asset class perspective? And it's going to depend on the SPAC. Is it a different way to play mid or large cap public equity? Is it a bond or partial bond replacement? Or does it potentially replace, arguably, and much more liquid, kind of VC in a portfolio? I suppose the answer to all of that is it depends.
Yeah, I think it depends. And I think that's why the SPAC market's gotten so big, is it really does have the ability to be different things to different people. If you're looking to buy, play in private equity, but with liquidity and with downside protection, there really is no other structure. Like as a SPAC sponsor, our favorite shareholders, so it's the polite way to say this, are not the people who use SPACs as a bond substitute, right? Because they buy the stock and then they sell the SPAC. They don't really care if you're doing a great deal or a terrible deal or anything in between. They're just looking to redeem and make that yield. So that means that we have to find another investor who likes the story and who buys the stock. And that's called de-SPACing or recycling, and it's part of every single deal. Like I can tell you, the people who are in at DraftKings at $55 today are not necessarily the people that bought the IPO at 10, right? So over time, the shareholder base changes as investors who buy the SPAC don't know what the target company is going to be. And then once the target company is announced, people say, oh, I like that. I like that industry. I like that management team. And they want to buy it. And who are they buying it from? They're buying it from the people who bought it as a yield substitute and are willing to sell it at a higher yield than they were expecting.
For sure. How would a family office, single or multi-family office, and will they start to become SPAC sponsors? Now, of course, I know the answer is they become a sponsor just like I do or anyone else. But do you see this as potentially being a future trend?
So we do, and it's funny. So Marshall Keefe, my co-CEO, comes out of the family office world, and the very first thing he said to me when we talked about doing a SPAC together was he saw this as a perfect co-investment vehicle for family offices, and it's where we're seeing it mostly is on the pipe side, and in both of the pipes that we've done in our SPACs. In the Converge 1 transaction we did for Forum 1 with Clear Lake Capital, and in Forum 3, which is a transaction that hasn't closed yet, we raised a pipe that had, and in both cases, we had substantial family office investments. So, family offices that want to go do a SPAC as a sponsor, put up the risk capital, go public, spend 2 years looking for a deal. Basically, that's a pretty activist type role, for a family. But for a family office that's looking to co-invest in a liquid security, being able to buy into that pipe, as we talked about, at $10, is I think a really logical way for them to, sort of dip their toe, if you want, in the SPAC world without becoming a sponsor.
We are going to get into your two deals and that closed and the one in the process now. We'll do a very short review of each, but taking people into a dive of what has happened and what's happening now, I think will be great. I will do this a little differently in that, as opposed to my traditional close, I'm going to say, as we're 80% done here, the sponsor of today's program happens to be, well, what a surprise, my company, Family Office Association. So a little bit of context. I'm the founder and CEO. Family Office Association is a global membership organization dedicated primarily to single family offices. We are global. I've been doing this a long, long time, and we adapted very quickly, and I could argue better than ever during COVID. I do hundreds of various programs, many of them specific evening programs, peer-to-peer programs. We have a private forum for members to communicate in kind of a specific network. We do a tremendous amount of content. I have selectively during COVID, I don't think I'll be doing one anytime soon, but have done some intimate roundtables very carefully. But sometime in 2021, we're expecting things to be a little bit more normal, probably closer to late second quarter, third quarter, and hope to have two more interesting and hopefully more significant programs again come third quarter later in the year. So we are really, really active. Simply go to Family Office Association to learn more. It's very easy. You can navigate it. It's very easy to join and really instantly be a part of the community, and the connectivity and sharing of ideas with peers and amazing families and SFO executives is what really is the glue that binds everything together. So go take a look. Again, familyofficeassociation.com. I would also recommend our other social media platforms, YouTube and all that, and we're Family Office on YouTube is very helpful. Okay, enough of my 90 seconds about that. Let's get back to it. So walk us through briefly, because there is, I guess, two past and one current, but some of the deals you have done and what's going on now for you.
Sure. Well, thanks. And again, I guess I should do a footnote, which is I'm not here to give investment advice, and I'm not trying to solicit. We have a pending deal. There's all kinds of regulations about soliciting proxies. We're not here to solicit proxies, but you can use them as an example. So I do think it's interesting to talk about the three deals, because in a way they're similar, in a way they're very, very different. So let me try them. First transaction that we closed was in forum merger one, was a company called Converge One in the IT services space. It was a portfolio company of Clear Lake Capital, very, very reputable private equity fund based in LA. And that was a $1.3 billion transaction. And when we started to speak to Clear Lake, the situation there was the company was ready to go public, literally had a prospectus done with very high quality underwriters. And they had an M&A opportunity they wanted to execute on. And they didn't want to put the IPO on hold, and they didn't want to put the M&A opportunity on hold, but the underwriters were saying, you can't do both, which is, very traditional thought process for an underwriter. So we said, look, we'll come in, you'll merge with us at the exact same valuation that the underwriters were promising you. So you're giving up nothing. We'll do the merger. We'll actually give you an earnout of additional shares if you complete the merger and hit your targets from that merger. Oh, and by the way, we'll also give you some cash off the table, which you can't get in an IPO. So we basically put a more flexible, better deal on the table for Clear Lake. We did the transaction. The IPO came out at 10. 6 months after we merged, we started getting takeover interest, and we sold the company for $12.50 in cash and a tender offer. So less than a year after the IPO, and there was a warrant and there was a right. So basically, investors who bought into that got out at, over $14 on over 40% return on, public just buying the public stuff. Tattooed Chef was a different story. Family-owned business, trades on the NASDAQ today under TTCF. It was a company in the plant-based food space, selling everything from acai bowls and cauliflower pizza to Costco and Walmart and such. The company was thinking of bringing in private equity, or actually even considering selling the business, because they had no idea that there was such a thing as a SPAC. They had no idea that they could take some money off the table, keep control of their company, and bring in growth capital all at the same time. In speaking to their investment banker, who I've known for many years, it was right when COVID started, and they said, "Oh, I guess we can't do anything. We have to sort of put the brakes on this." And we said, "No, if you're willing to do everything on Zoom, despite some bad cable connections, let's see how far we can get." And so we were able to negotiate a transaction with the company. Their manufacturing facilities are in California and in Italy. So all kinds of, hurdles to get through during a pandemic.
Yes.
But we got the transaction done. The stock is over $25 a share today. And it's been, very fortunate that it's been a great success. It's been a great company. With very good tailwinds in terms of, the plant-based food, healthy eating space. So that was a family-owned business. The first one was a sponsor-owned business. And we have publicly announced that Forum 3, which is our current SPAC, has entered into a definitive agreement to merge with a company called Electric Last Mile Solutions, ELMS. That transaction is expected to close in a few months. And it is a manufacturer of electric trucks for the last mile delivery space. And the chairman of the company is the former chairman of Ford China, and comes out of Accuride and Key Safety Systems. And our president, CEO, is the former president of Cadillac and Hummer, and the former chairman of Workhorse. So really top-notch management team, but pre-revenue business with about $1 billion in pre-orders. And so the first company we acquired had 100+ million of EBITDA, and the third company we're working on has 0. So we've gone a full gamut. But that's a $1.4 billion merger that we've proposed to them. We've agreed on, and we're just working through that de-SPACing closing process now.
Excellent. No, that's very helpful in terms of an overview of what you're doing, and certainly appreciate you taking time today. As I begin to close, if one of our live participants has a chat feature question, I suppose now would be a good time to ask it. I did get a text question in. It's a little out of left field, but I'm interested as well. It seems like the majority of SPACs are set up, registered in the Cayman Islands. Is there a specific reason for that? We do see some in Delaware. Maybe more of a legal and nuanced question, but I might as well ask it since he asked it.
Sure, I'm happy to try to hit that. So I would argue with that premise. So I think the vast majority of SPACs are Delaware companies. We are a Delaware company, but there's a lot of foreign issuers that do SPACs.
Yes.
And those do tend to be Cayman, as far as I can tell. And that just has to do with there's a very good established set of laws in Cayman, and it's easy to get funds in and out and such, on a above board, of course, basis as a public company. So if you're a company based in China or India or Israel or such, I came in, there's a few locations that people tend to use for incorporation. As you say, it's legal based, it's tax based. If you're not doing business in a certain jurisdiction and you register there, you may end up, incurring taxes there and such. So, but I would say the vast majority of SPACs that are US based and are looking for US targets are Delaware corporations.
Excellent. And although David did mention something, I will as well. A reminder, everyone, I'm recording this in mid-January. You may listen to it, well, even now, but a day from now, a month from now, years from now, and things could be completely different. It is meant to be strictly educational and hopefully a little bit entertaining, but everyone's situation is so different. You need to do your own diligence. You have your own time horizon, risk tolerances, and in investing, I always like to say you could lose everything. So be careful and very simply do your own diligence. It looks like we might have a question in from what, well, he was very kind. Sean, who's a very active investor on the West Coast, said, thank you for such a great presentation. So, David, you at least have one fan.
Hey, glad to help. Glad to help. Somebody, another SPAC fan.
Did have a little bit of a follow-up.
Yeah.
What sort of resources would you recommend for those that are looking to get more educated, I guess you could say, on SPACs? Is there a SPAC trade association? Is there?
There's not a trade association. That
Aha, something for me to start.
There you go, Angela, because I know you're looking for things to do. So there are a couple of organizations that do provide research. I mentioned earlier, SPAC Analytics is one. I think there's a firm called SPAC Research. There's a website for SPAC Insider, a former investment banker that focuses on SPACs. And I'm not plugging them just because we won Deal of the Year, People's Choice Award last week. But okay, so SPAC Insider is good. But every investment bank that's an underwriter of SPACs and every law firm that's involved now pretty much has a pitch book or a primer on SPACs. Some of those are publicly available on their websites as well.
And David, for those that would like to learn more about you and what you're doing at Forum Merger, how could they do that?
We are forummerger.com. Two M's in the middle there. We doubled the M. So FORUMMERGER.com.
And there is maybe a final question. Is redemption price guaranteed, and who is providing that guarantee?
Yeah, so the redemption price is a little bit of a floater. It cannot go below the $10. But so the SPAC takes its money, it invested in the trust account. The trust account can only invest in a very limited number of securities like treasuries. Otherwise, it becomes an investment company governed by the Investment Act, and you don't want to do that if you're a SPAC. So the treasury returns are obviously variable. So therefore that. And the SPAC really only has the right under most circumstances to take money out of the trust to pay the income taxes that it got for being in the trust. You would have Delaware franchise taxes, federal income taxes, maybe state income taxes. So those are the only really allowable expenses for most SPACs. And so there's I am sitting here today with a SPAC that has $250 million in the bank. And if I called the trustee and said, give me that money, they would say no. So you're asking who guarantees it. It's basically, there's a trustee that's in place that's only allowed to distribute money out of the trust upon a business combination or liquidation of the SPAC.
Well, thank you so much, David. It's great to have you on. Look forward to getting updates on SPACs as the year plays out. It's obviously very intriguing to investors and specifically to my single family offices. Everyone, I'm Angelo Robles. I'm the host of the Angelo Robles podcast, and I'm the founder and CEO, as I mentioned before, of Family Office Association. Check us out. Easy to join, familyofficeassociation.com. You'll figure it out. Very active on social media. Apple and Spotify is my podcast, the Angelo Robles podcast. And the social media that we're probably most active on is YouTube. Again, you could find it, but simply it's Family Office or Family Office Channel. On that note, again, David, thanks for being such a great guest. Till next time.
Thanks for having me.
Thank you.